All right, let's talk gold and silver. For decades, we've thought of them as partners, right? Precious metal twins. But what if that's not the whole story? What if one of them is secretly calling all the shots?
To get to the bottom of this, we're going to dive into a fascinating study from 2023. It's called On Volatility Transmission Between Gold and Silver Markets, and its whole goal was to finally settle this long-standing debate. So, let's break down what they found.
So, why has this even been a question for so long? Well, for as long as anyone can remember, investors have basically treated these two metals as near twins. They're both seen as safe havens, and their prices often seem to move together. But as we're about to see, that might just be scratching the surface.
So, before we get to the study's big reveal, let's just quickly nail down why the market has always lumped them together. What's the traditional thinking here?
In this slide, it lays it out perfectly. They're like a two-sided shield for your portfolio. On paper, they do the exact same things. They're a hedge against inflation, a store of value when currencies get shaky, a safe place to run during market chaos, and a great way to diversify. Same job, right?
But here's the catch. For years, the actual financial research has been, well, a total mess. Some studies would say, yep, stable, long-term relationship. Then another would come out and say, nope, that relationship is broken. Treat them as totally separate things. And that confusion, it has real consequences for how you invest. That's exactly the problem this study wanted to solve.
So how in the world do you cut through all that noise? Well, you don't just look at a few years of data, you go big. These researchers launched a massive 40-year investigation to find the real answer.
They looked at a period spanning from 1982 all the way to 2021, and think about everything that happened in that time. Market booms, the 2008 financial crisis, the pandemic. This wasn't some random snapshot. They picked a time frame that would truly test any relationship to its breaking point.
And to do this, they crunched a huge amount of data. We're talking over 2,000 weekly observations for both gold and silver. This wasn't a casual glance. This was a deep, deep statistical dive.
Okay, so they have all this data, and the key to unlocking the whole mystery, it comes down to one really cool concept, the echo of volatility.
It's a term called volatility transmission. Sounds super technical, I know, but it's actually pretty simple. Imagine the gold market is a pond, and right next to it is the silver market pond. If someone throws a huge rock, a shock, into the gold pond, does it make waves that splash over and make the silver pond all turbulent? That's what they wanted to find out.
And once you get that idea, it leads us straight to the core finding of the entire study, the big reveal, the answer to our question, who's really in charge here?
So, was it what everyone thought? A two-way street where they both influence each other? Or was one of them really calling all the shots?
What they found wasn't just a hint. It wasn't a maybe. It was an absolutely clear, unmistakable signal.
And just look at this. The data is pretty much screaming the answer at us. It's not a partnership at all. It is a one-way street, plain and simple. The volatility, the turbulence, flows overwhelmingly from gold to silver. The other way around, it's so weak it's barely even a factor.
So let's break that down. What it really means is this. When the gold market gets choppy and unpredictable, you can pretty much bet the silver market is about to feel those waves. A shock in gold's volatility is a reliable predictor for future craziness in silver. The reverse, it just doesn't happen in any meaningful way.
Okay, that's interesting. But here is where it gets really useful for anyone actually investing. Knowing that gold affects silver is one thing, but for how long? How long do those ripples last?
They didn't just guess. They nailed it down. A volatility shock that starts in the gold market continues to have a significant effect on silver's volatility for about, get this, 10 months. That's 40 weeks. That is a huge, predictable window of influence.
All right, so this is all fascinating stuff from an academic paper, but so what? What does this actually mean for you, for an investor or a trader? Well, it gives you a real tangible edge. First off, for diversification. It tells you holding silver doesn't completely shield you from a shock in gold because silver inherits that risk. Second, for traders, this is huge. If you see volatility spike in gold, you now have a predictable 10-month window to anticipate turbulence in silver, which is an incredible advantage for things like option strategies. It just means you can manage your risk so much better because you know gold is the real driver.
And hey, don't just take my word for it. The researchers who did the study spelled it out themselves. They literally said that investors could exploit this 10-month effect, especially in the options market, to create profitable strategies that maybe the wider market hasn't even caught on to yet.
So there you have it.
After decades of being seen as equals, we now have some seriously strong evidence that, in this relationship, gold leads and silver, well, it follows. It really makes you wonder, doesn't it? If this long-held market truth isn't what we thought, what other assumptions are out there just waiting for the right data to come along and turn them upside down?